session. Then we have questions and answers. Please, if you have questions while the discussion is going on, while the seminar or presentation is going on, you can write your questions. You can have a chat. I'll write them down, and then we'll read the questions and answers later. Then there'll be a wrap-up remark by our president. So that's the wrap of the day. Remember, I told you the last similar seminar was very, very good, insightful as well. As it is with tax issues, it is so important to listen carefully. I think it was Peter Drucker that once said that the most important thing in communication is to hear what is not being said. The most important thing in communication is to hear what is not being said. That's by the management guru, Peter Drucker. So I implore you to do your best to listen not only to what our special presenter is going to give us, but to listen to also to what he's not saying, so that the questions will be very insightful, and the answers also will give you something to carry home. Thank you very much. Without any further ado, I'll call my chairman, Mr. Lekan Ogunkoya, to give the opening remarks. Mr. Chairman. Hello?
Okay. Good afternoon, distinguished ladies and gentlemen. My name is Emmanuel Dangana. I'm the Deputy Chairman of the Professional Practice Group. I'm sorry I've been in touch with Mr. Ogunkoya, who is unable to join our webinar for technical reasons. He's trying very hard to join us now, but in view of the time, I will just have to step in. He has asked me to step in. So on behalf of the Professional Practice Group, we wish to welcome all of you today to this program, which is being organized by the Professional Practice Group of the Lagos Chamber of Commerce and Industry. We are proud to have in our midst the president of the chamber, Mrs. Toki Mabongunje. We also understand we have our DG, Dr. Muda Yusuf, and some of our past presidents, I understand. I'm not sure if our council members are here, but if they are here, we warmly welcome them. We welcome our speaker, Mr. Yomi Olagbenro, who indeed is qualified to speak to us to this topic, regarding this topic. So without, much, wasting of time, since we have lost a lot of time, I would like to, call on our president, if she's here, for our opening remarks so that we can proceed with the program. Thank you very much.
Thank you very much, Mr. Dangana. I think I must also say a big thank you to our very enthusiastic moderator, Mr. Mika Ndaxon. But just to make a slight correction, I know at the chamber we have a huge international reach, but for the sake of our participants and the audience, we are the Lagos Chamber of Commerce and Industry, not Lagos Chamber of Commerce International, but Lagos Chamber of Commerce and Industry, but very international in reach. Thank you very much. Mr. Yomi Olugbenro, FCA, West Africa Tax Leader of Deloitte, Mr. Lekan Ogunkoya, FCA, Chairman Professional Practice Group of the LCCI, very ably represented by his deputy, Mr. Emmanuel Dangana, officers and council members here present, members of the Professional Practice Group, Dr. Muda Yusuf, the Director General of the Lagos Chamber of Commerce and Industry, distinguished ladies and gentlemen. I'm delighted to welcome everyone to this seminar with the theme Finance Act 2020 and the Professional, organized by the Professional Practice Group of the Lagos Chamber of Commerce and Industry. I would like to appreciate our guest speaker, Mr. Yomi Olugbenro, FCA, West Africa Tax Leader Deloitte, for honoring our invitation despite his really tight schedule. This webinar aims to help professionals have deeper insights into the key ramifications of the Finance Act 2020 and how it affects them as stakeholders. Ladies and gentlemen, as you may be aware, the Finance Bill 2020 was passed by the Nigerian Senate on December 15, 2020, and was signed into law along with the 2021 Appropriation Bill on December 31st, 2020. The Finance Act 2020 consists of over 80 changes to over 14 laws, including the Capital Gains Tax Cap C1, Fiscal Responsibility Act number 31, 2007, the Oil and Gas Export Free Zone Act Cap 05, and Companies and Allied Matters Act number 3, 2020, among others. The act was designed to complement the 2021 budget of recovery and resilience by ensuring a balance between broader macroeconomic strategies to attract private investments, growing the economy, creating jobs, as well as providing fiscal strategies for accelerated domestic revenue mobilization in response to current economic realities. One of the three specific objectives that this act seeks to achieve is the harmonization of monetary, fiscal, and trade policies, and this is key to bolstering the growth and investor confidence in our economy. As a leading private sector advocacy group, we welcome key reforms that are introduced by the Act, which we believe will lead to improved fiscal outcomes. I wish to commend the chairman and the members of the Professional Practice Group for hosting this event. I appreciate the presence of our attendees, and I'm sure that our perspectives on the theme of today's discourse will be greatly enriched at the end of our deliberations. Happy deliberations to all of us, and thank you all for your kind attention. Thank you.
Thank you very much, Madam Chairman. So the next on the agenda will be the presentation by Mr. Yomi Aguero. Please, sir.
All right. Thank you so very much, and good afternoon. Let me especially appreciate the President of LCCI, Mr. Bokunje, the Chairman of the Professional Practice Group. I don't know if we have the DG also on the, on the call. Past President, I just huge respect and appreciation for the opportunity given to me to come and speak this afternoon on this important topic. I think it's a very well appreciated gesture and honor. So I'm trusting that the 1 hour or thereabout that we're going to spend together will be worth the time of everyone. So thank you for inviting me. So the conversation will be around the Finance Act, but more broadly, just an overview of the changing regulatory landscape, as it were, because the Finance Act itself, it's a response to a number of development within both the economy and the fiscal space, and it's an intervention that is situated within a broader context. So I felt it would be appropriate for us to just touch on, what the current realities around us are, both in terms of the economy and the fiscal landscape and some of the changes we are seeing, and then we can drill down on the Finance Act 2020 within the available time. I know I've been given about 40 minutes, maybe with some, when we're discussing in the morning, maybe with some grace for flexibility of around 5 minutes or thereabout. So, but I'll try to keep within that time so that we can then have discussion thereafter, if any. So my discussion, and I don't know whether you can see my slide. If you can confirm if my slide is.
Yes, we can see your slides.
Absolutely, thank you. Thank you very much. All right, so I'll kind of partition the conversation into maybe 4 key areas. So first of all, just a quick touch on the current state of the economy and some of the matters arising therefrom, and touch on the broader regulatory landscape and some of the changes we are seeing before we then narrow down on the Finance Act itself. We discuss some of the key highlights and some concluding thoughts around the future direction of things in the economy. So the state of the economy generally, I mean, I'm talking to the professional practice group and quite a knowledgeable audience here. So like many other African countries around the world, the number of concurrent realities or concurrent crises that every nation is dealing with, notable of which is the current pandemic, COVID, and all of the attendant health risk and business risk. You know, the wider health risk. Some countries are facing, you know, food crisis, some political crisis, some security, like us in Nigeria, and of course the attendant economic issues. So many of the things that we will be discussing or we've seen in Nigeria are not necessarily peculiar to us, as we know. So this is the realities around the world. And if you look at Nigeria, we had what we call some vulnerabilities that was prevalent in the economy even before we had the COVID-19. So what COVID-19 did was to, in a way, exacerbate the existing vulnerability of the country. We've had slow growth, even though prior to COVID, we were hovering around 2% GDP. We've just exited a recession maybe about 3 years earlier, right? So growth was still very fragile within the range of 2%. Inflation was rising, and so corporate margins are weakening, and there's a lot of pressure on the household. So this was a reality before. Fiscal and external imbalances, you know, were there. So many of the things that happened post COVID were essentially the worsening of, you know, very fragile situation. By the time we got to the second quarter of 2020, we had a, you know, negative growth of about -6%, and by third quarter we had, even though a lower rate of GDP growth, but it was still very widely in the negative. And so Nigeria was, you know, officially in recession during that period, just like many other countries, many other economies around the world. So, and this is consistent with what IMF, World Bank, and a number of economists projected that that was going to be the reality because of the lockdown of the economy and the rest. But the depth of the fall and how quickly each country will rise is what will differ, you know, depending on the fiscal headroom and what the you know, and the response and the swiftness of it. Thankfully, by the time the GDP we just had about 2 days ago, today is today Tuesday, we just had the Nigerian Bureau of Statistics release officially for us now the Q4 GDP, and we could see that the fourth quarter resulted in a very negligible positive growth of 0.11% for Q4. Now, what that means technically on you know, is that the recession, the negative growth trajectory had been truncated. And therefore, in principle, you will say we have exited recession by that positive growth. So the entire GDP for 2020 contracted by about just a little below 2%, by -1.92% against 2.2 that we have in 2019. So the growth for the entire year is negative of -1.92, but by the mere fact that we had a positive growth by the fourth quarter, it means we have exited recession. But this is still completely within the range of fragility, as we know, and the country may be out of recession. The broader impact, the broader economic impact is still going to take a few more years, a few more quarters for that to recede. But more broadly, and which is also part of you know, the limitation or the capacity of the government to be able to respond, is the revenue pressure that the country has been facing. The federal government had to revise downward in 2020 its budget for 2020. Revenue projections were reduced. because of the reality of the fall in oil price and the economic activity, the slowdown we had in economic activity. The Federal Inland Revenue Services, eventually achieve about 98% of its that reduced target, but it's a performance of below even the immediate prior year or 2018 and 2019. So ended up, raking in a little below 5 trillion naira, which is below the 2019 number. You can see from the chart on the graph, non-oil revenue, appear to be growing, marginally or steadily. But the upper lighter blue skin on the lower bar, you can see that the shape or the length of the bar is usually determined by how long that light blue section is, and that light blue is what represented oil. All right. So if we don't make as much, the entire country revenue will be in jeopardy, which is the reality of the country. So the dependence on oil as a major source of foreign exchange income and a major source of revenue for the government, even though from a GDP perspective, oil itself accounts for less than 10%, significantly below 10%. But in terms of source of funding for the government and source of foreign exchange, is about 90 within that range. So that's the reality of the economic crisis that the country has faced. But it's a positive news that at least technically speaking, we're out of recession. The Nigerian Stock Exchange was also reported by Bloomberg as the best performing in 2020, so some bit of positives. So, but the crux of the matter is still the heavy dependence on oil exports and the challenges that brings to the economy. A number of the development within the broader economy, it's a variant of the mono source of income, the challenge of total dependence on oil. So the oil price is the key determinant of a number of the economic outlook because of the impact on dollar availability, import trade, exchange rate, inflation, and the subsequent knock-on effect on affordability and consumption in the market. So not to even mention confidence of investor, of confidence of the business community. So it significantly drives a major part of our economic activity. I'm trying to be as quick as possible in this introductory part so that we can spend more time on the on the Finance Act itself. Now, so what has also happened, and what I think it's important to also bring to mind, is that government had continued to, making an effort around different fiscal measures to respond to, what is happening in the economy, right? The conversation we want to have around Finance Act is a major part of it. In 2019 was when we have the Finance Act instrumentality returned back to, our fiscal policy measures. Prior to that, it's been over a decade during the military when we last had that. And the beauty of this, or the reason why this was applauded by many of us, is that we know we've always had challenges with making laws. The petroleum industry bill that is still currently pending, I recall during the administration of President Olusegun Obasanjo, it was one Petroleum Profit Tax Act was one of the several legislation that was submitted to the National Assembly for review or for change, and it's never we've never been able to complete it. So the process of lawmaking is cumbersome, and we're not doing as well as we should be doing in this area. And so if a holistic change to the law is long in coming, can we at least make some changes to the existing one, look at the current reality, make some tweaks, review rates, review coverage, introduce a little bit of amendment here and there that will at least help to respond to the current reality. And that's what happened. 2019 was a very significant change that we brought about. And so 2020 also rode on the back of that. And the focus of the 2020 was essentially to respond to the COVID crisis and provide some bit of palliative and mitigations, against the risk. Obviously, the full impact of both the 2019 and 2020 Finance Act will still linger for a few more years because the business climate has not returned back to its full potential. So many of the provisions, the impact of them will last a lot longer. And in terms of changing regulatory landscape, AFCFTA, it's a major one, opening, the country to 54 other member states. The task of implementation has just begun, and businesses and professionals need to, be mindful of this reality, the potential upside, the risks to be aware of. These are part of big changes that is happening around us. In 2020, the Companies Act was also reviewed, it was also changed. So we had CAMA 2020. This introduced a number of measures that were aimed at, transforming the face of doing business in Nigeria. How do we leverage technology? How do we simplify the burden of compliance? So it's a major development that we need to be mindful of and evaluate the impact on our business. 2021, like every other year, had its budget. The budget's been approved, like the president did mention in our opening remark. It has some specific focus area that, as professionals and as business people, we need to be able to identify what are the strategic priorities, where is the direction, what are the things to be mindful of in order to appropriately position the business. And I will talk on some of this just briefly again in the course of the conversation. And the efforts by the government to beef up the revenue profile of the country is also another major thing that is happening. Strategic revenue drive to ensure that government is able to get as much as it can from the economy to be able to defray the cost of governance and to continue to keep the business going. So just a couple of some of the issue, but just around the regulatory landscape, I think one thing that has characterized many of the measures that we have seen over the last few years is that there have been a lot more short-term and medium-term responses. And I think overall, the kind of conversation that we should be having, particularly as this is a professional practice group, is that we need to start, influencing for a more long-term developmental plan. Like in 2016, because of the initial shock of the economic recession, we had, strategic implementation plan for 2016 budget. When the impact of the recession was heavy and the country was planning its way out of recession, we have the ERGP, right? The economic sustainability plan is in place now to respond to the health crisis, all right? But on a more sustainable basis, what we believe the country should be tilting towards is a long-term, a national development plan, which, if you like, can probably be legislated, such that successive administration, whether of the same or a different political affiliation, can continue to build on that, and we can have sustainable development in the country. All right. So, and ultimately, in terms of planning economic recovery, what the finance ministry is doing with, making sure that the business environment is eased and that we're able to raise more revenue, plan against the volatility around oil, and make sure that policies are a lot more integrated. These are some key policy measures that the government, has spoken about, but which require a lot more push and a lot more effort and a lot more consistency in making sure that we really get to where the country needs to do. And beyond all of that, I'll just touch on a few more things that is also happening that as professionals, we also need to be mindful about. So a lot is happening around automating different government processes and collaboration. Many agencies of government and departments are collaborating a lot more. There is a lot more reliance or a lot more effort to focus on data and intelligence. And you'll have seen that by the drive for national identity card for everybody, so that BVN and some data can be integrated. We think this will be a significant game changer if we are able to get a unique identifier for everyone. So it means driving compliance, getting everybody to be to contribute its quota. The ease with which the revenue authorities will be able to chase them will improve, and these are part of the measure. I've spoken about the petroleum industry bill. We think if this eventually gets through, it will be game changing. The revenue pressure as it persists, what you will expect is that government will continue to be under pressure to reinvent and find means and ways of raising more money. So even though what was done, as you will see in the finance side when we get into the heart of the discussion, is that because of the current economic reality, government, decide that it is still too fragile for new taxes to be introduced or tax rates to be raised, and therefore the focus is how can we optimize what we currently have, how can we provide some bit of immediate palliative. But the truth is, as the economy improves, the possibility of a rate increase or widening of the tax net, the possibility is very significant. I thought I should also kind of share very briefly around in terms of the regulatory landscape and what's happening around the budget 2021. The total spending plan is about 13.6 trillion or thereabout. But I think the core of what I want to call out of this is essentially the revenue pressure and how realistic and the impact on how government will continue to focus on taxes. Within that 13 point something trillion, there is a deficit of about 5.6 trillion or over 5 trillion, 5.5 trillion. That is planned as deficit, which is only going to be financed by borrowing and sale of some asset of the government. So the gap in terms of raising revenue is still a huge burden. If you look at the narratives, it will appear as though the oil sources, it's taking lesser and lesser share of the revenue, but a critical look will tell you that it's because for 2021, there's a lot of focus on independent sources rather than non-oil taxes. So there's still a huge gap for the government to look for oil sources. So the non-oil tax revenue is about 1.5 trillion out of the total 8 trillion that government expects to make. Oil is about 2 trillion. So independent and other sources is what is accounting for over 55%, of the remaining. The recurrent debt expenditure is still a burden. It's about 42% of total expenditure, is 71% of the revenue, that government expect to make. And if you look at our performance as at 2011, the total amount of revenue that the government has been able to make of its plan, it's essentially from just about 75% or 70% of it is what was raised. So meaning that the amount of revenue government will make, both from oil and from non-oil, is probably what is required to focus on recurrent non-debt expenditure. Our debt obligation is rising because of the paucity of funds, and that's what makes the pressure continue. I will just skip this, but I'm sure the chamber will share the deck. What I've tried to do is to include some other reference materials in terms of the key priority areas for capital expenditure for recurrent. That's not really our focus, but you can pick on that when you get the slide. Now, focusing and going specifically to the main agenda for the day, which is the Finance Act. It became effective on 1st of January 2021. 14 laws were amended and over 80 sections in that Finance Act. So meaning that what we're going to be discussing will be essentially the summary, so it's appropriate that you lay hold on the Finance Act itself. It's not such a lengthy document, just about 81 sections in all. But the focus is on tax policy reform, introduce some bit of financial management and public revenue goals for agencies of government. And like I mentioned earlier, it's premise within the current economic challenges and the pressure that the businesses is facing, and therefore it attempted to create some bit of structure that will lessen the burden of the economic impact that's brought about by COVID, at least in the short and medium term. If I summarize what I would call the 5 key thematic areas of what the Act intend to do, first is to respond to the economic challenges and the volatility in oil revenue, and so try to create some bit of palliatives for businesses, or at least make some amendments that were not directly targeted at raising rates. So increases in rates were deferred. So in this new act, we don't have new taxes introduced, neither do we have any rates that were raised. The decision is that until the economy sufficiently recovers, we can be it won't be conducive for businesses to be raising taxes. But obviously there are provisions, as you will see, that the indirect impact of those changes may lead to some tax increases, and I will touch on maybe 1 or 2 of them. It also tried to institutionalize the paying taxes reform. The Presidential Enabling Business Environment Council has been doing a great job at trying to improve the country's ranking on the ease of doing business and ease of paying taxes. So some of those policy measures, attempts were made to institutionalize them by making them a point of law rather than policies. Government also attempted to reform the incentive regime and try to bring in some bit of justification to reduce the proliferation of different incentives that are coming that have been given to different businesses. So some bit of cost benefit analysis to justify them. And obviously it tried to support the revenue drive of the government and improve utilization of budget. So the laws that were changed, you can see on the screen: Companies Income Tax, Personal Income Tax, Capital Gain Tax, VAT Act, Stamp Duty Act, the Customs Act, Education Tax, the Pioneer Legislation, NEPSA, Oil and Gas Export Processing Zone, the Fiscal Responsibility Act, Public Procurement Act, the FRS Establishment Act, and CAMA. These are the 14 laws that were amended by the Finance Act 2020. So talking in terms of changes, I have summarized into 2 slides. Slide 1 talks about the key changes that I consider to be potential gains. And the second slide will talk to the changes that I consider to be potential pains. I will limit my conversation to those 2 slides, but on the deck, I've done a further breakdown of some of the changes on law by law basis. So you see changes under VAT Act, Companies Income Tax, Personal Income Tax, but the key ones I have tried to call out. So I may not go into each of the law one by one. So the slide will provide some additional material that you can read. So in terms of the potential gain, I think the first one, very notable, is a reduction of the minimum tax rate by 50%. And this is significant because in 2019, the method of calculating minimum tax, or maybe minimum tax provision rule, first of all, the concept of minimum tax is that in every year, businesses need to pay a minimum amount by way of corporation tax to the government. And it's usually calculated using different parameters. You look at your net assets, your paid up capital, your turnover, and all of that, and different percentages. Now, this has been, criticized in the past as, why will you continue to tax capital effectively? Because if a business is making loss, that's when the business will not be able to pay tax. So, but if you ask them to pay minimum tax, they are practically paying out of capital. So why not change this? Why not eliminate it? Why not reduce it? Part of the complaint then also was that some companies or some categories of company were exempted from minimum tax, and one of them is company that has imported capital. If you have up to 25% paid up share capital by foreigner or foreign investor, you'll be exempted. And there were complaints that this is discriminatory to local businesses. So in 2019, that law was changed. One of those changes was that imported capital no longer qualifies you for tax exemption. Only a Greek business and new business will qualify.
but the method for calculating also was simplified, and it was only 0.5% of your turnover. So it becomes very simple. You don't need to look at 4 or 5 different parameters to determine what is minimum tax. Now, during the pandemic period, many companies reported losses, or will be expected to report losses. And so government felt in order to, and 0.5% of turnover is huge, especially if you look at it from where we're coming from. Prior to that, it was 0.125, of turnover as one of the 4 parameters that you will use. The higher of, 0.125% of turnover, and then you look at net asset and you look at paid up capital. So 0.5 was really a huge deal because it's almost like 4 times of what it was before. So there were a lot of complaints. And so as a temporary relief for 2020 and 2021, the rate was reduced by half. So instead of 0.5% of turnover, it's now 0.25. And there will be a huge percentage of businesses that will be impacted by this because most of them will pay taxes using minimum tax rule. So the tax was reduced by half. But this is just a short-term provision. It's only available for 2020 and 2021. Unless the law changes again by financial 2021, that provision will cease to exist. Import duties and levies on tractors and motor vehicles were reduced. This is part of changes that were introduced. There was also specific provision for deductibility of donation made by corporate bodies and individuals to disaster relief fund, to the pandemic fund particularly. And the idea is that because prior to now, there were specific provisions in our law that listed what type of donations are deductible. And this wasn't part of the item listed. So government made specific provisions so that companies who have bankrolled the COVID-19 medical intervention can claim deductibility. We also have VAT exemption on flight fares and leasing of agricultural equipment as part of the changes that were introduced. Micro and small businesses have clarity around whether the education tax is applicable to them or not. Because in 2019, when the exemption for businesses that have 25 million naira or less, exemption from company income tax was made, there were questions that then came up later on what will happen to education tax. FRS tried to issue some bit of guidelines to say it will not be applicable, but that's a circular by FRS is not the same as the law. And so we now have specific provision in the law that says, yes, small business will also enjoy exemption from education tax. We also have for insurance businesses, definition of gross income and gross premium. The idea here is that the ambiguity in calculating the minimum tax applicable to insurance business has been removed, and so they can enjoy the same type of benefit that other companies enjoy on the minimum tax side. Also, as investment in technology and software infrastructure continue to expand, government has now, the law has now introduced the software costs, investment in software as a capital expenditure that will be eligible for capital allowances. Before, it was the hardware that was, usually being seen, and there's usually a controversy between the tax official and businesses as to whether software qualifies for capital allowances, plus the upside of an additional 10% investment allowance, like the way you have it on property, plant, and equipment before. We also have moratorium for tax exemption for agri loan, now reduced from 18 months to 12, so that more financial institutions can benefit from, claiming that tax exemption, and also direct the flow of finances to that very critical sector. Individuals also now have provisions to deduct from their taxes life assurance premium. We have it reinstated. Another major provision that is very beneficial is that, just like we have it in 2019, the burden of taxing a single year more than once, which happen to businesses when they are newly commencing business and when they are ceasing business. We call it commencement and cessation rule, as many of you know. We now have that provision introduced into PITA as well, personal income tax, so that individuals and partnership can also enjoy it. The change that happened last year was inside Companies Income Tax Act, and so it really wouldn't have affected individuals and partnerships. So, but now it is. Sales, rent, and leases of properties are no longer eligible for, will no longer attract VAT. So we have that as part of the changes that were made. Individuals that are earning minimum wage and below, they are no longer required to pay taxes. That's part of the change. But I guess the only question people ask around is the fact that the amount is really very small, because I think minimum wage currently, if my understanding is correct, it's about 35,000 naira a month, 30,000 naira a month or thereabout. So if you earn 360,000 or thereabout per annum, you won't be required to pay minimum tax. Prior to now, everybody pay minimum tax. But those at the very lower end of the spectrum are now to be exempted. I have mentioned VAT exemption on flight fares and list of agribusiness. Another area where VAT and import duty exemption was also granted is on lease of commercial aircraft, and purchase of aircraft spares. So these are some of the notable changes that I think are quite very beneficial, and depending on your own business, the impact can vary. All right, or the veracity of the benefit can vary. So I will touch on some of the changes that I think probably don't attract as much smile as the earlier one. One is telecommunication service provider in Nigeria is now liable to excise duty. Like I said, not that excise duty was newly introduced, but this change will mean telecommunication service will now, be liable to excise duty. So it's just a expansion of the coverage of excise duty. Also, prior to now, excise duty is only applicable on locally produced excisable items, right? Tobacco, alcoholic beverages, and the rest. Now, this change now says if you import those goods as well, it will be liable to excise duty. The idea is to remove the discrimination against local manufacturing of these items. So if excise duty is applicable when you produce them locally, how much more when you bring them in? So that's discrimination has been removed. So both imported and locally produced excisable items, we now attract excise duty. Approved companies that are operating within the free zones, tax-free zones, they are now mandated to file their annual self-assessment income tax return. This doesn't necessarily mean that they will pay tax, but the idea is that when the tax authority review the books of these free zone entities, if their activities have not been constrained within the free zone and they have operated within custom territory, if taxes are applicable, then they will pay taxes on those custom territory transactions. That's ultimately the drive. The same way, non-resident companies are now required to prepare audited accounts and to file them with the tax authorities. So that's part of the change. For individual, one change that I think is very significant, and a number of people have complained about it, especially because of the current reality and the fact that government is meant to be providing palliative and not to be raising taxes, is that there was a provision that redefined the meaning of gross income for individual. Breaking it down in a very basic way, what it means is that when this definition is applied, the basis for calculating the consolidated relief allowance that individuals are entitled to, that base will shrink, because what the gross income says is that we are going to deduct things like pension, things like insurance, things like your NSITF contribution from your total income before we allow you to calculate CRA on the balance. So if the base for calculating the CRA has been reduced, then the relief will be small, and therefore your taxable base will go up, and ultimately your personal income tax will increase. So that change is one, probably almost with an unintended consequence, because if my understanding serves me right, what the government was trying to do here is to sanitize the abuse within the pension area particularly. So there have been some bit of abuse, maybe like that's been prevalent many years. About 3 years ago, we have some bit of sanity by the PENCOM, and what happened then was that individual would typically give instruction to their HR and finance department to put so much in their voluntary pension and get their taxes reduced, because voluntary pension is eligible for tax deduction when you are doing your tax calculation. But there was an ambiguity, or there's a gap in the law that people were exploiting. They go back to their pension fund and collect the money just almost every month once the deduction is made. So when this was realized, PENCOM introduced a chain that limit access to your voluntary pension only once in 2 years. And you can even at that access only 50%. So it was, I think the build up to this provision was actually that abuse. But this now affects everybody because it's not limited to voluntary pension. Every pension you are deducting will first of all have to be deducted before we calculate tax on the balance, right? Individual with significant economic presence, that are operating from outside of the country but have significant economic presence in Nigeria, they're also now liable to tax. In 2019, it was targeted at company, particularly companies in the e-commerce space and technology company who are operating in the country. And by significant economic presence, the definition that was given in the guideline issued by the Minister of Finance is that if you earn about 25 million naira, which is an attempt to link it up with the base for small businesses that are exempted from tax in Nigeria. So if you do up to 25 million naira, you have significant economic presence in Nigeria, you need to pay taxes. Now individuals are having exactly the same. One other change, which it's not necessarily a new tax, it's just a clarification, but it introduced some bit of compliance burden on the employer, is payment for loss of office. In 2019, we have a provision that was introduced that if you earn up to 10 million naira as severance benefit, you will not be liable to capital gains tax. But it was a bit unclear as to what happened if you earn above that. So in 2020, that change was now clarified that if you earn above 10 million naira, the excess, your employer is to deduct capital gains tax at 10% and pay it to the government. One more change, maybe the final one I will just touch on, is the creation of the unclaimed dividend and dormant account balances, the fund that the federal government has now set up to mop up the fund in this area. So if you have unclaimed dividends, or you have some bank account that are dormant and you have balances there, a fund has been created by government to sweep off those balances there. But this sweeping only happens after the account has remained dormant for 6 years or the dividend has remained unclaimed for 6 years. And the government also did mention that when the individuals involved eventually shows up, the fund will be paid back. All right, so those are some of the key changes, and we can discuss this a little more. Maybe there's some specific question. Like I did mention, I've tried to highlight in subsequent slide some additional, maybe break it down law by law so that you're able to know whether this one affects Companies Income Tax Act or whether it affects Personal Income Tax Act, which changes are in Personal Income Tax Act, or whether it's in the VAT Act, or whether it's in the Capital Gains Tax Act, or whether it's in the Education Tax and the rest of the law. So I've tried to highlight them on a law by law, but the summary is what I have initially provided. Now, what I would just like to do is just in terms of looking forward and in terms of how all of this will affect and what will be the shape of things for 2021. A number of people have, a number of economists and the rest have postulated different scenario. Will it be an L-shape recovery? Will it be a V-shape recovery? But more and more, it's looking more like a W-shaped scenario. And so what will happen in the economy and the way government will respond will be more or less a little bit of cyclical movement, So just like we saw prior to December last year, the curve was flattening and it was reducing. And then because of the December movement and the second wave started, and so the graph shot up again. And so we will expect, if the policy measures, particularly the vaccine and the rest, if they're effective, there may still be some bit of curve, but maybe the sharpness or the height of the curve will not be as high, as it's been. And this trend is consistent across different economy. So from a business perspective, what we said in Deloitte is that there are probably three different ways to segment this. So there is a moment of, lockdown, and when the pressure is really heavy, which somehow it seems to have navigated that. We said, how do you respond to manage that continuity? So, and then we move to the 6 months up to 1 year later, when it will be like a recovery phase, for you to learn and and emerge stronger, perfect the way you have been running your businesses, perfect the way you have been thriving using technology, running your business through technology. And when that curve appear to have flattened, because it's probably going to take a long time for the virus to be completely eliminated, then it will be a thriving phase where what you do essentially is to just get used to the next normal and try to plan your business. In terms of what the scenario will be for 2021, Deloitte has also come up with 4 different scenarios, and those scenarios will be, in our view, dependent largely by 2 things: government response, and how quickly, how effective that response is. And then the second will be the effectiveness of the vaccine. Now, if everything goes well, government responds very well in a coordinated manner, and the vaccine is effective, we are going to have the top right upper quadrant, which we call a new dawn. All right, and there are different growth projections for each of these scenarios, which I may not necessarily have time to go through. Now, if the vaccine is effective, but government response, government response is not that effective, it will be hard rain. All right. The scenario that we don't want is that vaccine is ineffective and government response is ineffective. So it will be, an endless winter scenario. And the bottom right is a situation where we have effective government response, but the pandemic lasts a little longer because of the ineffectiveness of the vaccine. So it will be sunshine. I won't go into some of the details of each of them one by one, but generally, in terms of the projection for Nigeria, looking at where we have been over the last 5 years, I think Nigeria has experienced a growth of roughly 1% if you look at our average over the last 1 year. All right. So, and looking at the recent statistics by the NBS, that the 2020 contraction was below 2%. All right. With the positive growth we have in Q4 of 2020. Taking all of this into consideration, our view would be that Nigeria is likely going to bounce back to the 2019 level, maybe in the next 3 years, by 2024, if we continue on the trajectory that we've been over the last 5 years. So that's what we think. So bringing it all up so that I can close now, I think I've spent about 42 minutes now, is that for businesses and for professionals, what do we have to do? We need to individually assess the impact, because we represent different businesses. Some of us are in practice, some of us are representing our clients, some of us are in different spheres of endeavor. So these things affect us differently, and so impact assessment is critical. Thinking more strategically is even more important at this point. So how do we pilot the business during this current phase? How do we rethink, how the business strategize, and how, as professionals, how can we help our businesses and our companies to plan and strategize for business continuity and for future growth? This will obviously require that we build capacity, that we continue to learn and relearn and trying to make sense of all that is happening, and also anticipate future change. It's going to be a turbulent or some bit of bumps ahead, because the pressure will remain very heavy on government to raise more revenue. The pressure to deliver on infrastructure commitment will be heavy, and the gap is widening, or the bar is rising so high as far as the budget, the deficit and debt financing is. In 2021, we exceeded the threshold that the Fiscal Responsibility Act says our debt to GDP ratio should be. I think the rate is about 3.5, 3.6 that the Fiscal Responsibility Act says. We're ending up in 2021 with about 3.9, so we have exceeded. But of course, the law allows the president, if it's of the view that there is the situation is that critical and it's required to be raised, and in its wisdom, the executive, the federal government thinks we are in that situation, and so they exceeded a little. The fact that our debt to GDP ratio has always been good, has always been one of the things that we use to justify our debt. We rarely comment about the capacity or the amount of revenue that's available to finance it. So we spend it so much to finance, like you saw in the earlier chart that I presented, the total amount that is expected from oil and non-oil will practically just equate the amount that is needed for debt servicing. And so unless we borrow, we can't do capital projects. So this will continue to raise pressure on government, and that will mean it's not yet time for us to anticipate government slowing down on raising rates or putting tax pressure on business. So my concluding thoughts and final slide, therefore, is that we need to continue to anticipate and sense the changing regulatory landscape. Things are changing in the global. If the Federal Reserve cuts rates today, before you know what's happening, the impact is here. So as professionals in a different endeavor, we need to have a risk sensing signal, quite active, so we can sense these changes. Digital revolution has been accelerated by COVID, and so businesses can only thrive if we are powered by technology. And so this has to be a constant measure that we're adopting. If we're practicing as professionals, you're only going to be able to thrive to the extent to which you leverage technology. And so because the pressure will continue, it is critical that you block compliance leakages, understand the law, understand how it affects you. Government is sanitizing the incentive environment. There will be a lot of cost-benefit justification that the government will be expecting. In 2021, government is going to issue what we call the tax expenditure statement. And what this is going to do is to provide cost-benefit analysis for the various incentive schemes, pioneer, different exemption that is available. And so you will see constant withdrawal and blocking of many of these incentive area if there is no cost-benefit justification. So you need to rethink your business and say, how can we optimize what we have in the immediate and prepare for what will happen? And of course, building capacity on a continuous basis and making sure that you create a response mechanism that will respond quite quickly to pressure and scrutiny that is coming from the regulatory authority will be a key determinant to how you survive in the current landscape. So that's about all that time will allow us to share this afternoon. I want to thank you very much for inviting me and for listening to me. I'm hoping that maybe there will be opportunity for Q&A or for feedback or discussion before we draw the curtain finally. Thank you so very much. It's been my pleasure speaking to you. So I yield the floor, Mr. Moderator. I don't know if you can.
All right. Thank you so much, Mr. Yomi. That was an excellent presentation. You've opened our eyes to so many things, right? From the overview of the general economy, how it impacts us, what government is doing, the Finance Act per se. You've done a lot, giving us some stories about achieving economic recovery, and then technology, that we have to do a lot, collaborate a lot in that, data intelligence and all of that, up to the real key issues on the 2020 Finance Act, the highlights of the gains, many gains for us, even individuals and companies. And then the pains as well. I don't want to repeat all you have said. There are so many pains, especially the telecom service, providers being having some kind of duties now that may affect their tariff. Also, they will have to pass it to somebody. Somebody has to pay for it. And all those other downside of the budget. Well, and then the recovery. The W shape, that's going to be painful also, because it's going to be like a roller coaster. Unless we're careful, we can even go back to to go back to current situations. And it all depends also on the government response, as you pointed out very, very well, depending on how rapid they respond, the vaccine effectiveness, and how they would, whether it will be generally acceptable, as somebody was already asking a question. And then the real impact come home to the businesses. How do we respond? The individual business people, we have to rethink and then respond and then reposition. There are so many areas that you have mentioned. Individual companies, this impact assessment, so important. And then strategic thinking, capacity building. It's going to be rough, but I think we together can make it happen. There are a lot of things that you said we should be anticipating for 2021. A lot of changes, as you've said, both globally and locally. And the real thing is that there's a revolution going on. We have to prepare to respond. And more importantly, what you have is so important. So you've emphasized blocking compliance leakages, because sometimes you don't comply, that's why you get hammered. That's it. And then continual capacity building is so important. Actually, unfortunately, find out that when the economy is hard, that's when people refuse to train. So if you have a sharper saw, when times are hard, your people can cut better. But you find out is the companies think differently. I think we have to also have a paradigm shift in the area of capacity building. We have to, well, now it's a little bit easier with Zoom and all that, train our staff, build our people, and all of it to give people ability to respond rapidly. Because time is of the essence, just a year and it'll be gone. So we're so very, very grateful for this erudite presentation. And I will just open the floor now for more discussion, some interactive and probably questions and answer sessions from the floor. Thank you so much, sir. We appreciate it.
Thank you, my pleasure. Thank you, my pleasure. So I have a question on the box. Someone asking if the slide will be shared. So I will make it available to the chamber. So I'm sure it will be shared with members. Thanks. I guess it's time for us to entertain questions. So the Q&A box, I believe, maybe we can use the Q&A box, or I don't know what approach you want to adopt. Maybe members want to raise their hands to
yeah, okay. I think that's the floor is open for that. Q&A through the chat. Whether you want to have a question, you raise your hand. We'll give you time to go ahead.
So while we're waiting for that, I think there was one of the comments, I guess just a comment where someone has kind of re-emphasized the point I made around the personal income tax, that it looks like a maybe somewhat insensitive thing to do at this time, that the allowances are already too low, and that raising personal income tax at this time may not be the best. I share your views. Like I mentioned, it looks to me, judging by my insights and my, some limited involvement in the process, I must admit, because I think the government did consulted. One of my partners, one of our partners in the group was also a member of the National Tax Policy Implementation Committee that supported the federal government in collating and suggesting views and all of that. But when laws are being changed this way, there's a lot of interests that are covered, a lot of inputs that are covered from different angles. The tax authorities also make inputs, the professionals make their input, the business community makes its input, and you will expect what the input of each of those parties will be. So the tax authority whose burden is how to raise more taxes are likely going to make provisions that will be geared towards blocking leakages. Businesses will be asking for reduction of taxes. Professionals will be trying to make different suggestions that will introduce a bit of fairness, into the process and all of that. So, but my view is that the focus of that change originally was targeted at blocking that abuse, but the impact appeared to be more wider covering. I must also admit that it's not like the impact overall on the pay is that huge, all right? So especially if the individual wasn't making so much of voluntary contribution or part of those who were abusing the process. So the tax will raise, will increase, but very marginally. It was only necessary that I did call it out as a change, just for a balanced view of what the act is, if you understand what I mean. So do your scenario analysis. All that you need to do is to just make sure that when you're calculating your PIT before, instead of calculating your CRA on your total income, whatever your pension you are deducting or any other schedule 2 or so that we call it, any of those deductions you make, first of all deduct it before you apply the CRA. CRA is 200,000 plus 20% or 21% straight, depending on whether you end up to 20 million naira or so. So you will see that the impact, even the tax will rise, but not that fundamentally. All right. So hopefully by the time the input for 2021 is received, we'll be able to have change. All right, so a number of questions, sir. If you allow me, maybe I just pick the question, some of them in the boxes. Is that right, or
go ahead, sir.
Differently?
Go ahead. If that will be repetition, just go ahead. I saw the one in Karma 2020 and finance, and which one supersedes?
Okay, so please, sir, is the increment in VAT the best way to increase IGR? Well, maybe if you say, is it the only way? I would say it's not the only way, but is it the best way? Well, that's the alternative the government has introduced. There are definitely different ways of increasing revenue. One of it is to widen the base. That is, we have a significant number of businesses and individuals who are not currently paying taxes or who are not paying what they should pay. We know a lot of illicit financial flow that is happening. So one thing that government could do would be to concentrate a lot more on driving enforcement, on driving compliance, and making sure that more people get into the net. That's one way. But obviously, raising rates is, it's a sure banker. It should increase, especially if you don't lose the number of people you already have in the net in the first place. All right. So, but is it what businesses will want? Definitely not. One of the arguments for VAT is that Nigeria has one of the lowest rates when you compare with around the world. And I always say that itself is true, but also with some bit of comma. And it is true because on the surface level, before we move the rate to 7.5%, 5% is perhaps the lowest you can get of any country doing VAT other than those that are zero. All right, so we're really low. Neighboring country, Ghana, Kenya, South Africa, and all of that, Africa average is way double that. When we're at 5%, some 12.5%, some 15%, some 17.5%. Now, but the question mark around our own is that our VAT is itself a glorified sales tax because of the limited input VAT claim. All right, so if you don't claim input VAT, or you have limited claim, because input VAT claim is only limited to goods you produce for resale. All right, so if you are in service or you incur VAT on capital expenditure or you incur VAT on overhead item, you are not able to claim it as direct input set-off. You only add it to your expenses and claim it as part of expenses to be deducted in your income statement, or you add it to the cost of your assets if you want, if it's a property, and claim it as part of capital expenditure, capital allowances. So you don't necessarily lose it, but there's a difference in the cash flow and in the timing. All right, so that's the only question mark. But I must say that the increase to 7.5 does not still necessarily, eliminate the advantage Nigeria have from a rate perspective. So even if we consider the input VAT claim, so everyone, the World Bank, and many professionals think, subject to the way you moderate the impact on the economy, because you can do a give and take. All right, VAT is one of the indirect taxes, and for professionals like me, I've always advocated that the indirect tax is a much more efficient and effective way of collecting taxes by the government. But what you need to do is to do a bit of balancing with direct tax. All right, because that's what the Nigerian national tax policy also said. So there's a shift towards indirect tax. It's a lot easier to administer. It's a lot easier to collect. It's a lot easier to evade. Some of us on this call, even if we're not sure whether we have paid personal income tax for 2020, I can bet you that you'll probably pay VAT today because you will have consumed certain type of service. And you don't necessarily have to go and queue in front of any tax authority to pay that VAT. You just pay it through the vendor and the merchant that you are buying things with. So government have very few number of merchants to chase, unlike tax compliance when individual personal income tax, when government needs to chase everybody. So, but what can be done is that while you raise the VAT progressively, you can also provide some bit of cushioning on the direct taxes. So the personal income tax is lower, so you have more disposable income in your hand, you spend more, and because of the national propensity to consume by Nigerians, you spend virtually 70 kobo of every 1 naira that you have, if not more. So there's a multiplier effect, and government can recover whatever it loses on the direct tax by increasing the indirect tax. But the two need to work together, not just for us to say VAT is low, therefore let's keep increasing it and do nothing on the direct tax. The tax policy says a gradual shift towards indirect tax, meaning we lower the direct and move towards the indirect. This year, no increase because of the impact. I can almost hazard a guess that next year is going to be a discussion on the table, especially if the economy has recovered. The rate, another question, an anonymous attendee says, the rate at which the Finance Act passed through the process and gets signed off, hope the major stakeholders are carried along with the amendment. The truth is that it was a record passage for 2020 Finance Act, and it's because it was a crisis situation. The consultation process was a lot more broader in 2019, or it took a lot more time than in 2020. But nonetheless, there was still input, there was still consultation, just that it didn't go through that lengthy process when you have many weeks to respond. So if you didn't respond almost immediately, government has moved to the next phase. But some of the input were also carried forward from the 2019. The input process for 2021 is already here. I mean, it's already been ongoing, although informally. So my advice would be, particularly for the chamber, to be able to make input into 2021, the best time is today. So you need to get ready and articulate views of the members, and so that when government open the process officially to say, please bring your input, we are already, prepared well ahead of time, and that can happen. More light on telecommunication excise duty. Yeah, so I mean, one of the there are specific excisable item, notably tobacco, non-alcoholic beverages, and the rest. So what government has now done is to say telecommunication service is one of it. So, and there are specific rates that is, applicable to those. So that will rake in some more money, because one of the sectors of the economy that is thriving at this time, it's is the telecom sector. On the issue of voluntary pension, is it liable for tax deduction? Yes, it's liable. But I've only mentioned the impact when you are calculating your CRA. What should be the expectation of SMEs and MSMEs in regard to the new finance law, revenue, expense, and regulatory? No, nothing changed that will negatively affect MSMEs. If anything, I think it's the clarification around exemption for education tax. So all of the benefit they got in 2019 still remains, plus the fact that they no longer need to think about education tax as an additional benefit. Can we objectively advise the tax authority to put in place an effective tax net that will ensure that the rich pay more while the poor less? Well, Mr. Femi, I think the issue is actually not of the LRS or the FRS, because these are administrative bodies that are just there to administer the law. We need to change the law to either introduce wealth tax or introduce graduated rates that will, further make the rich, to pay more. There's some element of progressiveness in the current tax rate, because if you look at it, it's in bands, first 300, next 300, 600, if you earn about 1 point. So it's already graduated. So if you earn ₦1 million, your effective tax rate will be different from somebody who earns 20 million naira. All right, so whereas you may be having a single-digit effective tax rate, you may end up having a double-digit effective tax rate of say 15, 16, or whatever. So it's already progressive to some extent, but we can obviously do more. All right, because in many economies around the world, over 80% of the personal income taxes is paid by the top 1%. Now, the challenge with our own is not even that the rate is not progressive, is that the really wealthy people are not probably even the tax nets. So these are the individuals who have different kind of business structure. Their companies pay tax, but individually, the personal income tax is not effective enough to be able to deal with specific individuals. So it's a matter of the law and not a matter of the FIRS, because FIRS just apply the law the way it is. Now that individuals are included in the significant economic presence rule, what will be their withholding tax rate? Will it also be 10 or 5? No, the rate is determined by the nature of service that you render, and the rate has not changed. You know, if you are doing general contract and supplies, it's 5%. You know, depending on the nature, technical services are typically 10%. So it's the nature of the service that you are rendering, which effectively for this type of service may end up being 10% if it's categorized as technical. But the real answer is go by the nature of the service to be able to classify what rate will apply. Please stop me if you think I've taken enough of the question. I don't know what time is applicable for this.
Go ahead. We're enjoying it.
Okay. All right. The Finance Act is progressive on the part of government. I expect the scenario going forward for the government to quantify the impact of the act on government. Absolutely. That's part of the policy measures that, I mean, I've had the privilege of also sharing with the Ministry of Finance, that we need to do M&E, monitoring and evaluation, impact assessment. So it's good to introduce measures, but can we also quantify the potential impact, you know, so that we can use this as input into what direction should follow. How does the new pension deduction would be deducted by both the employer and the employee? You know, so the contribution by the employer, the pension contribution by the employer, is a tax deductible expense as part of payroll cost. So that hasn't changed. The same thing for individual. But what we're saying is that when you are calculating your relief allowance, what the law says is that you will first of all deduct it from your gross income. All right, you deduct it from your gross income before you apply the 21% or 200 plus 20%, depending on what your income level is. If you earn below 20 million and below is 200,000 plus 20%. All right, if you earn above 20 million, you can just simply use 21%. All right, so before you apply that 21%, the base is that pension as part of other 5 items or so that you may be entitled to, but I know most people is just essentially pension. A number of people don't have separate life coverage policy other than the one the employer have for them. Some people don't even do NSITF contribution, you know. So the one that is quite common to everybody, is the pension. So it's deducted from your gross income before you apply the percentage. How will bigger companies deal with withholding tax for smaller vendors, which are designated by Finance Act as exempted? Fortunately, this is still an area where maybe in the future more changes will happen. The current rule is that a tax exemption does not exclude the company that is buying your services from deducting withholding tax, but you are entitled to claim refund from the tax authority. So, and we know that in a practical sense, the process of refund can be a bit cumbersome, and it takes a while. It typically will probably it requires some bit of audit or review, and so expect some bit of administrative process to go through. All right, before you're able to do that. All right, the world is currently moving towards digital economy and blockchain. More companies are leveraging on the emerging technology. What's the impact of the Finance Act on digital assets? Nothing specific has been said about this from the Finance Act perspective. Of course, the only pronouncement that we've had is the one you noted here, where CBN did prohibited financial institutions from funding or supporting blockchain and cryptocurrencies, cryptocurrencies and the rest. But I can say that from tax law, typically the way the taxman will view any business transaction is that whatever is not exempted is taxable, and there is no legality of the source of any when it comes to tax, whether it's illegal money or legal money. If it's income to the taxpayer, the revenue authority will typically tax it. So unless that transaction is not known, non-identifiable by the revenue authority. So that's what will typically happen in the absence of any specific regulation. But it will remain an area where we all continue to ask for a rethink of the entire process, because measures that will increase inflow of foreign exchange into the country shouldn't be one that we should be shying away from. We should, many different economies are warming up to this, and we can keep silent and be oblivious to what is happening. Mr. Larry Lawasa, joined late. Is it true that a company with less than turnover will file account and tax? Okay, so yes and no. So there are different tax obligations. The one that is very clear, where the small businesses do not need to file any returns at all, is VAT. The law specifically says you won't charge VAT on your turnover. You don't need to render VAT returns and the rest. Now, but company income tax, you are not liable to pay taxes, not education tax, not company's income tax. However, submitting your return has not been changed. What the law says is that even companies granted exemption from paying taxes are supposed to submit returns. The same is applicable to not-for-profit organizations. They are not supposed to pay taxes, but they're supposed to submit their returns. I guess the thinking around this is that it's by voluntary assessment that you have considered yourself to be 25 million. There hasn't been any review or validation of that claim. For not-for-profit, you are the one that have said you haven't done any business activity that is for profit. So you will expect that either for data gathering, either for information, either for appropriate statistics, or for a verification of your claim that you're actually a 25 million naira turnover, you're supposed to submit that return to the tax authority. So return submission, yes, for companies' income tax, but not the monthly VAT obligation. Can we apply, Mr. Kazim, can we apply for refund arising out of reduction of minimum tax rate from 0.5 to 25 in 2020 assessment year? Yes. Yes, if you've paid based on 0.5, you are entitled to 0.25 for those 2 years. Can I explain the rationale behind the CBN ban on trading cryptocurrency? No, not more than I have explained. My knowledge in the area is very limited. All right, more explanation on the cost of donations made in cash or kind to set off. Yes. So this question is asking for the comment around the deductibility of donations. So I did mention in the law, both Personal Income Tax Act and the Companies Income Tax, there is a specific schedule of donation that are deductible, and there's also a cap to, I think, about 10%, of the amount that can be claimed in a particular year. Donation to disaster relief or pandemic of this nature was not one that was specifically listed, even though on the surface level you will assume that, well, we will have pushed it, which we'll have done anyway, because it's a donation to, this is an approved or this is a recognized government disaster recovery claim. But tax is a matter of law, and certainty and clarity are key objectives or key principles of taxation. So in order to make it abundantly clear, so there's no doubt as to will I be able to claim deduction or not, the Finance Act 2020 then make specific provision that made it clear that if you donate to this kind of disaster relief fund that government is setting up at federal and at state level, you will be allowed to include it as part of your expenses that you will claim. All right, and you will be able to claim deduction. Mr. Adeyemi, I believe this question is for either the DG or the president. How can the chamber address the issue of multiple taxation? I'm sure they will speak to that. But my guide will be as an umbrella body, we can continue to collect views, all right, around specific challenges that our members are facing. And let's be very specific. There is an overuse of the word multiple taxation, multiplicity of taxation. What exactly are those multiplicity of taxation? Because in a few cases as a professional, I must say that sometimes some of these multiplicity or strange taxes that people talk about, sometimes, not all of the time, are brought about by ignorance. Because we have an Approved Levies and Taxes Act that specifically listed the number of items that state, federal, and local government are supposed to be liable to. Of course, I think the list under the federal is about 21 different taxes, 25 under state, about 20 different levies or so under the local government level. So some people don't sufficiently understand this number of taxes. So these levies, some of them are not taxes per se. Parking fee, TV license, burial charges, stickers on the car. There's a number of them. All right. So let's be sure that the one we're talking about is actually not on the list. Now, if it's on the list, what we're saying is how can government consolidate this number of levies and this number of taxes so that we don't have the pain of continued multiplicity of taxes. I think I saw a comment that we should wrap up, if I'm correct.
Yes, sir.
So can you? Okay, so I yield the floor then.
Yes, thank you very much, Yomi. We are very, very grateful for your insights and your very, very educated presentations. We're very grateful, and we'll come back to you soon again. To come and seek for your advice. We appreciate you, sir. I will now welcome our President Chairman of the Professional Practice Group, Mr. Lekan. He's joined late, so I want to give him the privilege of giving the closing remarks to reinforce our thanks to you, sir. Thank you. You're welcome, sir, Mr. Chairman.
Yeah, thank you very much, my Vice President, my Vice Chairman, Programs. I want to thank Madam President, the President of the LCCI, Mrs. Toki Mabukunje, Council members present, past Chairman of PPG, and the members of the PPG, and also most especially the ESCO members for the support and rallying around to ensure that today was a success. I must apologize that I came in a little bit late. I had some technical issues, but thank God I took part in the deliberations. I also thank everybody that has found time to be part of this deliberation on the 2020 Finance Act, and also those that asked questions. And also I want to sincerely thank our presenter, our guest speaker, Mr. Yomi Olugbenro, for his time and also taking us through the rudiments of the Finance Act, sharing knowledge with us, also enlightening us through the questions that have been asked. So on behalf of the PPG and the ESCO that are here, I want to sincerely thank everybody for the time that they have taken to be with us. Fortunately, we had a lot of people that registered for this particular program, over 300 participants from all over the world that registered for this program, and I think that is a wonderful thing that happened to us. And on that note, I wish everybody a very happy and a wonderful evening, and I wish us the very best as we apply the Finance Act, advising our various clients, also knowing it for ourselves for the future. And one thing that is a takeaway for me here is that there is need for advocacy, by the LCCI, even for the next year Finance Act that would come up. I know that Mr. Agbenro mentioned it, that there should be input of the LCCI. And we as the professional group will take that in and begin to work on having an input for the chamber for the 2021 Finance Act. So thank you very much, and I wish you all the very best. Thank you.
Thank you very much, Mr. Chairman.
Thank you, everybody.
Thank you, everyone. Thank you, Mr. Lugbenro. Have a
Thank you,
wonderful
Madam
day.
President.
Thank again.
Thank you.
I
Thanks
really
a lot.
appreciate
Mr.
it.
Bukoya, thank you.
And-
Thank you for the.
And then for the questions, I don't know if we can spare time to, offline to answer some of those questions because there are a lot of questions. I don't know.
Well, we can do that, subject to availability of Mr. Olugbenro.
I think we've almost run through them. I was running through, so the last I have 1, 2, 3. From what I can see here under the question box, there are only 4 left. I try to run through.
Okay, that's fine.
From the top.
Okay.
Yeah.
Okay. Thank you very much. Bye bye, everyone.
Some of them are quite similar to the earlier ones, so just about 4.
Okay. Thank you very much.
All right. Thank you.
Thank you very much, Yomi.
Pleasure, sir. Thank you.
All the best.
Thank you.
No. Oga Micah, well done, sir.
Thank you. I didn't see the questions.
recording has ended. Sorry?
I didn't see most of the questions, actually. I think they were directed mostly to
they were not on the chat. They were on the question. They were on the Q&A.
Okay.
Yeah, they're on the Q&A.
That's good. But marvelous paper. Actually, a lot of insight. Yeah.
Yeah, very,
especially
very well.
the macro. The macro is very essential. The big picture. Him painting the big picture. The other micro picture, some of them are known, but the macro especially, getting prepared for all this rethinking, repositioning, capacity building, those are the things that are larger than that 2021. And he gave a very, very professional direction towards that. So it was a very good paper.
Yeah, it was. Please, Henry, have you stopped recording? And, this is a private chat amongst the ESCO. So have you stopped the recording, Henry?
Henry, are you still there?